Imagine you walk into a computer shop and buy a laptop for rupees 40,000 by paying cash. Have you ever thought about how this transaction is recorded in accounting? Well, that's where debit and credit come into play. Hi everyone, welcome back to InfoCraze. Today we will break down debit and credit in the easiest way possible. In accounting, every transaction affects two accounts. One account is debited and the other is credited. But what does that mean? It means to record any accounting transaction, we need to pass an accounting entry which will involve two accounts. Thus, the most important task for passing an accounting entry is to identify the accounts that are affected in a particular accounting transaction. This task will become very easy if we segregate the affected accounts based on modern approach. So what is this modern approach? As per modern classification, we have 5 types of accounts. These are revenue, expenses, assets, liabilities, and equity. Out of these 5 types of accounts, expenses and assets are debited on increase and credited on decrease. Rest of the 3 accounts, revenue, liabilities, and equity, are credited on increase and debited on decrease. Thus, let's look at these rules for debit and credit, which is summarized as per the modern approach in the chart. Let's understand these rules with some real life examples. To start with, we take up the first example, where we imagined that you bought a laptop from the computer shop by paying 40,000 rupees in cash. In order to pass this accounting entry in your books, you need to find out the 2 accounts that are affected by this transaction. In your accounts, the 2 accounts that are affected are laptop and cash. Both these accounts are assets. Laptop is a fixed asset and cash is a current asset. As the laptop, which is an asset, is increasing, you need to debit the laptop account by rupees 40,000. On the other side, your cash balance, which is also an asset, is decreasing. You need to credit the cash account by rupees 40,000. Now, let's take another example. Say the computer shop pays salary of rupees 30,000 by check to its employees. How is that accounted in the books of the computer shop? The 2 accounts that are affected are salary account, which is an expense, and bank account, which is an asset. As the salary, which is an expense account, is increasing, it will be debited by rupees 30,000. On the other hand, bank account, which is an asset, is decreasing. Thus, bank account will be credited by rupees 30,000. Hope you are able to understand these rules for debit and credit as per the modern approach. This way, you can pass any accounting entry very easily. If you have any doubt, please share your queries in the comment section. I will be happy to help you. Though the modern approach is the easiest way to decide the debit and credit entries, there is a traditional approach too, under which the accounts are classified into personal and impersonal accounts. Impersonal accounts are further classified as real and nominal accounts. Under this traditional approach, we have the golden rules of accounting for debit and credit, which you should be aware of for any exam or job interviews. Let's have a quick look. Personal accounts, as the name suggests, are accounts related to persons, which can be natural personal account like John's account or Rahul's account. Artificial personal accounts like companies, bodies corporate, association of persons, partnerships, etc. And representative personal accounts like outstanding rent account, prepaid insurance account, etc. For these types of accounts, debit the receiver and credit the giver. The second one is real accounts, which include assets and liabilities of a business. These accounts are not closed at the end of the financial year and continue to appear in the financial statement of a company in the balance sheet and carried forward to the next financial year. For this type of accounts, debit what comes in, credit what goes out. The third one is nominal accounts that are related to the expenses, the losses, the incomes, and the gains. And these are temporary accounts. The balances of these are transferred to the trading and profit and loss account at the end of the financial year. The rule for these types of accounts is debit all expenses and losses, credit all incomes and gains. Thus, we have discussed both the approaches, the modern approach as well as the traditional approach. In case of any doubt, do not hesitate to put the query in the comment section. With this, we come to the end of this video. If you find this video useful, please like the same and share it with your friends. You can subscribe to my channel for many such interesting videos in finance, accounts and costing. In case you want me to cover any particular topic, please let me know in the comment section. Thanks for watching.